But here's the other thing I've kind of learned about American culture is that we will push the limits beyond the point where we know we're in trouble, but we'll keep pushing it until we break. And I think that's what's happening right now with our debt levels.
This is All Star Allocator. I'm your host, Austin Jia. Today, we're joined by Matt Zumbach, the president and CIO of the endowment fund at the Baylor Oral Health Foundation. Over the years, Matt's built a great track record of managing institutional capital, from his time at Aon, where he oversaw multi-billion-dollar pension plans, to his current role. He also found time to teach equity valuation at Kellogg, so you're really getting a masterclass today. We'll be talking about how he evaluates new opportunities, portfolio building, and his view on today's market. These are the conversations I love and rarely shared publicly. Without further ado, let's dive in. Matt, welcome to the show.
Thanks, Austin. I'm really excited to be here.
Okay, so Matt, for those who may not know you yet, can you share a little bit quick overview about who you are and what you do today?
Yeah. So as Austin said, my name is Matt Zumbach, and I'm the Chief Investment Officer of the Baylor Oral Health Foundation, which actually goes to support the Texas A&M School of Dentistry. It's a long, weird history, but we go to support that program. It's about a $100 million foundation, and I serve as their Chief Investment Officer. In addition, I'm in the process of launching my own RIA called Divergent Path Advisors that I'll be doing on the side, helping individuals with their investment decisions. If you really break down what I'm doing is I'm helping both institutions and individuals make good financial decisions, particularly on the investment side. I spent most of my career in institutional investing. I primarily focused on pension plans for the better half of a decade. And now I've moved into the foundation world working with Baylor over the last year. I also spent some time working for a collateralized loan obligation fund. So I had a little bit of experience on the buy side. And then in an interesting twist, I also spent some time as a treasurer for a private equity owned company on one of their portfolio companies that was preparing for an IPO. Now, if you really zoom in on a few of those, I was at the CLO during the CLO boom from 2007 about 2005 to 2007. So right at the peak, and I left before that market crashed. So my exit timing was fantastic on that one, just by happenstance. That's when I decided to go to grad school. When I was working for the private equity company and we were preparing for the IPO, I left about a year before we officially went public, and they went officially public through a SPAC during the SPAC craze. So my timing in some of these positions has been very interesting, and it's been a phenomenal part of my overall career experience. Outside of the career, you'll find me often training for triathlon, or better yet, I have a 3-year-old daughter who somehow figures out how to out-negotiate me on everything. So I spend a lot of time trying to battle with her, or talking to my wife about some spreadsheet that I built that she's not that interested in. But overall, that's what I'm doing with my life and where I'm at career-wise, trying to keep things as well balanced as I possibly can.
That's super fun. So how did you decide that investing, when did you discover the interest? And I heard it started early.
It did. When I was about 12 years old, my dad convinced me that I needed to take some of my money that I'd earned mowing lawns and working at a grocery store and investing it in the market. And he had me read this Fortune magazine article about the best performing mutual funds and had me select one. I ended up selecting one of the mutual funds, and it went up in value. To this day, I actually don't know if it beat its benchmark, but I did see the value of my investment rise, and that really interested me. And I asked my dad, well, how do mutual funds make money? Why is the value of this fund going up? And he said, well, the mutual fund selects individual stocks, and based off of how they perform, that determines whether the mutual fund goes up or down. And I thought, well, why don't we just select individual stocks? My dad said, it's really hard, but let's try it. And he got me into my first stock that I ever owned. And that one, ended up luckily doing well. And when I say well, it just means it went up in value. Again, I have no idea how it went in comparison to any sort of benchmark. And that stock, I ended up making something like $50 or $75, which I know doesn't sound like a lot, but for someone who is earning $5 an hour bagging groceries at the local grocery store, $50 to $75 equated to 10 to 15 hours worth of work for me. And that made me hooked. And I was so excited. And I started investing more and more in the market. And if you put this in perspective, this was all during 1998, 1999. By this time, I was about 18 years old, and it was right during the internet bubble. And no matter what I chose, the market was going up. And it was fantastic, especially since I was interested in computers and technology, and that's where all my money was going. So I rode that wave up, and I thought I was the greatest investor, only to watch that thing crash down. And I lost all of my gains and then some, and ultimately was down on a lot of the investments that I made. It was a very formative time for me, but that's how I got started with investing. And I learned a lot of lessons from it.
I mean, a lot of people say market timing isn't the most important thing, but I guess it does change careers.
It absolutely does change careers. It had a big influence on me.
Yeah, yeah. So when you realize, like, okay, so you experienced the boom and then the bust. When did you realize this is not just a passion, this is not just a side project, and you may want to do this full time as a career?
Yeah. So the weird thing about me, Austin, is I probably wasn't what you would consider a normal kid. Uh, I was a short, skinny white kid from Iowa with no athletic talent, no musical ability. I couldn't act. And so while most people wanted to be an athlete, wanted to be a musician, wanted to be a famous actor or something like that, I knew that wasn't in my future. I guess I had realistic expectations. And from pretty early on, I knew I wanted to do business. And money and math was two things that always interested me. My grandpa actually taught me how to play blackjack when I was a kid, when I was 5 years old, and I learned about odds and statistics. And I felt that related a lot to investing. And I started getting interested in investing, partially because of my grandfather, partially because of my dad. But when I really realized it might be a good career for me was actually after the internet bubble popped. Because while I was emotional about my losses and I was very upset because I didn't like losing money, at the same time, I found myself asking questions of why was a company one day valued at over $200 billion, and then 3 months later or 4 months later, all of a sudden valued at less than 100 billion? Why was its value cut in half? How could that happen in such a short time frame? And because of that curiosity that I had, I thought that maybe this could be, a career to pursue so I could help answer those questions and figure out why the market reacted the way it did. And, as a result of that, that really is what got me into investing, is the fact that I lost a lot of money and I wanted to prevent it from happening again. And I started asking questions about it.
All right, that makes sense. Yeah. So when you think about endowments, for example, right? Let's be more specific because
Okay.
it's very specifically
Yeah.
designed. So endowment, what do people get wrong sometimes, and what's the general perception that people don't understand how endowments are managed or allocated?
Yeah. So one thing I'm going to say, I'm going to caveat this, is that I've been in my position specifically working for this foundation endowment for the last year. So the endowment world is a little bit newer to me in comparison to the pension world, where I spent about 10 years. The one thing I would probably say is that the endowment world, again, it's not going to be a one size fits all. And the nice thing about the endowment world is a lot of them have some more internal teams, which we can get into the difference between having an internal team versus an external advisor. And what you're going to find is that everyone has a slightly different investment style. And as a result of those slightly different investment styles for endowments or foundations, is that you can ultimately leads to, very different types of investment portfolios that they have. The other component I was going to say, and this is something that I learned when I first started at the Baylor Oral Health Foundation, is that there's a difference between a private foundation and a public foundation. And I had no idea what that distinction was. And there's two key components. One is a public foundation, you have to have a public support test, which means enough donations coming from a variety of third party independent sources in comparison to the general income of your portfolio. If you meet that test, then the second component, which is a key differentiator, is that you don't have to pay out 5% of your foundation's assets each year to the beneficiary. You can actually pay out a lower amount. And if you have a public foundation versus a private one, that's going to give you a lot of flexibility in how you manage your portfolio, because you have the ability to pull a lever in times when maybe the market crashes and you can't pay out as much of your portfolio without starting to destroy the corpus. So that is one really interesting nuance that, candidly, I did not know until probably about my second week inside the job at the Baylor Oral Health Foundation.
Got it. Yeah. So when there's opportunities come to your desk, like a new opportunity that you don't have a ton of prior knowledge about, how did you go about it? Do you run the numbers first, or do you see the story works? What's your process?
Yeah. So Also, I'm going to say this is going to apply whether I was working at Northern Trust as an OCIO and we were trying to onboard a new client, or if I'm even looking at a different investment opportunity. If an asset manager is coming to me with a strategy, or if I'm looking at an individual security to invest in. And you might be surprised with this, especially based off some of my prior comments of, things like you have to do the math because the math is extremely important. It actually leads with the story. I need the story first. I want to understand your thesis. I want to understand your process. I want to understand how your team is set up. And I want to understand why you think this is a good idea. Now, I'm going to have a huge caveat with that, though. While the story leads, and it's what I need to hear first, it has to be backed up by the math. Again, you have to do the math. And here's the reason why is that if the math and the story don't match up, then something is off about the particular investment idea or investment process that you might be trying to pitch or might be trying to implement. And I think one of the better examples, and this is going back to my early career investing that we talked about earlier, is that when I was 18 years old, I loved the story behind American Online or AOL. They were a gateway to access the internet. And I felt that the internet was going to be a game changer in terms of business and personal use. And I thought that AOL was building these great barriers to entry, creating a huge network effect. And as a result, I thought that AOL was really going to be the bridge between people who needed to use the internet and where they were going to get their information. Now, that theory in general ended up being wrong, but stick with me for a second. Let's pretend that that theory and that thesis was actually going to be true and that thesis carried out. Had I actually known how to run the numbers or ran the numbers back when I was 18 years old and plugged in my assumptions about what would have happened with AOL's revenue growth and margin growth over the next 5 or 10 years, I still would not have gotten to the valuation that AOL was trading at the time. So it had a great story, in my opinion, but the math was not going to back it up. And I was buying AOL at prices that I should never have paid for it. And had I known back then what I know how to do now, I probably would never put my money in that company.
Got it. One thing that in my finance career that I've heard is equity valuation, doing the math can help you find if this person, let's say using the person as example, is in his 30s or in his 80s, right? You can actually see the bigger difference. But how do you actually see if this person is actually in his 30s or in his early 40s? Like the margin of error gets much bigger when the valuation gets smaller. And do you think math can do that?
So I think math gives you guidance and gives you ranges. And I think what you're ultimately saying is that if someone's in their 30s and we're looking at maybe an individual stock, or if you're comparing it to someone in their 80s, it's when do you hit that steady state, which is ultimately when you do equity evaluations, you need to get to that steady state where they're not growing at, 50, 30, 20, even 10%. You need to get it to a state where they're growing closer to, 2 to 5%, preferably, closer to what GDP is growing at. So those valuations get much harder when those companies are in their 30s and they're younger because you have to be able to forecast for a longer period. So yeah, those valuations are a lot tougher. But at the same time, you can start to run the numbers and see how long these aggressive growth rates have to last. And then you just need to ask the question, do you think that they can continue to grow at this particular rate for that period of time? Michael Mauboussin from Morgan Stanley actually wrote some really good articles about the embedded information in a stock price. And what he was getting at is that, look, you don't necessarily have to make your own set of forecasts. Just back into the numbers of what the stock price is implying. And then you need to make the decision. And I'm oversimplifying this, by the way. I think he'd probably be upset based off of my simplification of this great article that he wrote. He goes, then you could back into the numbers and then you have to make the decision. Are these numbers realistic? Are they achievable? And what is the probability of these numbers being achievable? And then that can help you make the decision of whether or not you think this is a good stock to buy, a good stock to short, or one just to completely stay away from. I think that's what you were getting at with that particular question.
Yeah. Yeah, exactly. And you said like the story matters to you, right? Like then, there's investment thesis, like basically there are two ways of doing things. One is I invest thesis driven. So I create a thesis, I do a ton of research to have a direction for my entire portfolio, at least or I believe the fundamental things are true. And then I go along the way to find those opportunities that, invest to support that thesis. The other way is just to be open to opportunities like when it comes to your desk, and if this is a good individual opportunity, you pursue that, right? The obviously pros and cons, and for the first one, there's an important dangerous point, which is what if you got wrong? What if the thesis is not what pan out and your entire portfolio is constructed towards that? How do you think about those approaches, and which one do you prefer?
So typically, I actually prefer the thesis-driven investing. And yes, you can be wrong, right? There's not going to be situations where you're right. But I think the key is with thesis-driven investing is that you've got to be able to take a look at those scenarios where you might be wrong. And if you are wrong, what does that downside look like? Can you actually handle the downside in that bad scenario that you've just described? And in that case, if that downside is too large, are there ways to mitigate that risk? Are there ways to hedge it? And maybe that means you're diluting your thesis a little bit, but if you're able to cut out maybe some of that tail risk, the thesis dilution is how I would say it is probably not as big of a deal. So I really do like ones where you are trying to predict what's going to happen and have some sort of thesis, whether it's a macroeconomic driven thesis or some sort of microeconomic driven thesis. I tend to gravitate to those types of strategies. And I think it maybe is even just a bias that I have. Opportunistic investing, while I don't necessarily completely stray away from it, it sounds a little bit too much and often feels like when people are talking about these opportunities, a little bit like market timing. And and maybe it's not actually market timing. That might not even be the case in some of these situations for opportunistic investing, but often I find those to be somewhat correlated. Now, I'm going to even say there is one of my favorite funds that I've ever invested in was a private credit fund. And they raised about $1 billion for this fund. They closed it and then they didn't call capital for a year. And the reason was is they had 5 signals that they were looking for in the market, and 4 of those signals had to be true, at least 4 of them. And it took a year for those 4 signals to come true. And actually, when it came true was during COVID. Right at the peak of COVID, 4 of those signals started to flash and they started to call capital. Now, if you remember what happened during COVID, we had that V-shaped recovery. It took about 4 months for those 4 signals to all go away. And they stopped investing. They ultimately ended up only calling 25% of the capital. That was it. And they only made money on the 25% of the capital that they called. But they said it's no longer in the environment that we want to be investing in. We want to be sellers. And they started to sell. And the fund did extraordinarily well. Unfortunately, only 25% of what we had committed was ultimately called. But that 25% did fantastically well in the market. And that was a little bit more of an opportunistic style. And guess what? That fund did great. And it was a very interesting strategy that they had.
Interesting. Yeah, that's great to hear. Yeah. So when you are evaluating opportunities, like how do you define risk, and what type of risk is like worth taking or a good risk to you?
So when I think about risk, and I'm going to go back to how I kept harping on, customization for a lot of these plans. And ultimately, when you create a customized plan, one of the things that you are trying to customize towards is what type of return do you need in order to meet your goals? So if I'm thinking about risk and I know I have a certain return that I need in order to meet my goals, that's going to imply that I need to take a certain level of risk. Right? Fundamentally, I believe in the higher returns that you're going after, the higher levels of risk that you are going to be taking. So ultimately, when I think of risk, I think about the total risk, the minimum level of risk I need to take in order to meet my longer term goals. And as long as I'm staying within that general risk target, I feel like I'm taking relatively good risk. Now, I'm going to go one layer deeper than that, though, is that if I know what my risk target and return target looks like, the next thing I'm going to try and do is at least diversify that risk as much as I possibly can. I want to be able to take not necessarily equal amounts, but I want to balance it out between things like duration risk, credit risk, equity risk, inflation risk, general economic risk, things like that. And I want whatever asset classes I'm exposed to have those risks as balanced out as I possibly can without negatively impacting my return. And that's not always easy to do. And sometimes some of the risks are going to be larger than others, and it's going to be disproportionate depending on what my return targets are. But as long as I develop that framework of trying not to take more risk than necessary and diversify the risks as much as I can, I would define that as a good amount of risk and good risk to take. If I ever start taking more risk than I need or have very disproportionate types of risk in my portfolio, whether it be interest rate, credit, duration, equity risk, things like that, is when I start to feel that the risk that I'm taking is bad. Or in general, if I don't understand a strategy or how something that works, that's horrible risk to take. Because if you don't understand it, just stay away from it.
Right. That makes sense. Yeah. Invest what you know, or at least you should know.
No, yeah, pass on it. If I'm the
Yeah.
idiot in the room, that I don't even want to touch it.
Exactly. So if we bring everything together, right? Like maybe create like a high level framework for us to understand how you do a portfolio construction, and if there's anything changed over the years that you learned from the job.
Yeah. So I actually have what I think is I'm going to break it down into 5 steps. And I know you said to keep it high level, and I'll try and keep it relatively short. I know I can be long winded sometimes. But step 1 is just define your goals. I need to know where we are going, where we're trying to head to. And unless I know the direction that we're going, I'm not going to be able to set our portfolio strategy. All right. So with the goal set and knowing where we need to get to, just like that running race here, you're running a 100-yard dash or you're running a marathon, you start to develop the strategy that way. Step 2 is you need to start building assumptions, volatility assumptions, return assumptions in order to build a portfolio that's going to help you get from point A to point B. And with those assumptions, I want to get a diversified set of assumptions. And in my prior jobs, prior to coming to the Baylor Oral Health Foundation, is I worked for companies that put together their own capital markets assumptions, and I was only able to use theirs. That's it. I couldn't go to a competitor. I couldn't use somebody else's. So one of the nice things about working with Baylor is that I can use a variety of capital markets assumptions. And I'm going to take those capital markets assumptions, and then I'm going to start building out for step 3, these efficient frontiers, saying, okay, what is going to be the minimum amount of risk I need to take to hit certain types of returns? And I build out tons of efficient frontiers, first unconstrained, where there's no limits, constraints on any asset classes. And then I'll start building in constraints. And I'll look at all these different efficient frontiers, and I'll start to tease out biases in the capital markets assumptions. I'll start to tease out trends, and I'll start to see something that might look like an investment strategy out of those efficient frontiers will kind of begin to develop. And ultimately, I will start to build a strategic portfolio that meets our return targets, that balances out the risks as best as I possibly can, and doesn't exceed the risk that we need to take. Now, that's step 4. Now, step 5 with this one is probably the thing that I learned the most throughout my career, is that it's more than setting a strategic allocation. I need some sort of framework for tactical asset allocation. I need some sort of framework for rebalancing the portfolio. And emotional rebalancing from the board members, even from myself, candidly, was horrible, right? It didn't work. You try to time the market, you panic. And ultimately, I created something called this goals-based rebalancing when I put together the portfolio construction. Mm-hmm. And honestly, this has been one of the biggest differentiators in my clients' portfolios that I have seen, and it's worked wonders for us. Goals-based rebalancing basically says, if you are getting closer and closer and closer to your goal and you're nearing that finish line, that probably means you could take less risk. If you are falling behind where you thought you were going to be, or if you're falling off of track, you may need to take more risk. Now, that's going to work out relatively well with fluctuations in the market, right? It takes a little bit of the emotions out of it. And if I have enough time, I'll give you an example of this. In 2020, we were onboarding a new client at Northern Trust. And we had set their investment strategy. We knew that their pension plan wanted to be fully funded in about a 5 to 10 year time frame, preferably a little bit closer to 7. So we set an investment strategy that we thought would get them there. Now, this is January 2020. We are in the process of onboarding them. Mid-March, we are not fully onboarded yet. We haven't transitioned everything over. Our transition date was April 1st. Mid-March, middle of COVID, markets have tanked, interest rates have gone down, their funded status fell. Their starting point drastically changed. And we were having a meeting with them, and I said, have your goals changed? And they said, no. I said, well, the finish line's at the same place, but your starting point is in a lot worse situation. We need to throw away the strategic portfolio that we previously built. We need to redo it at this point in time. And they said, why? And I said, because you're going to fall so far short of your goal, you're not going to even be close to the finish line. And ultimately, we rebuilt the portfolio. We took on a lot more risk, and this was at the bottom of the market. And we didn't do it because we were making a market call. If you would have asked me at the time, I would have told you we weren't going to have a V-shaped recovery. It was more what needed to be done. In order to reach our goal, that portfolio needed to be drastically rebalanced or repositioned. And we did. We ultimately put on a lot more risk in that portfolio. And when the V-shaped recovery happened, not because we made that call, it massively benefited that company. And it was huge for them. And then the crazy thing is, as a result of that, their funded status improved so quickly that by the time 2022 happened, or right before 2022 came, when the markets were down and fixed income was down and everything was terrible, we were able to de-risk their portfolio because now they were ahead of their original goal, and we materially de-risked them. And then when the markets crashed, they were in a pretty good de-risk position. So that goals-based rebalancing strategy really worked out for us. And that was one of the biggest things that I've learned that I've now implemented for Baylor. I back tested it for Baylor and said, if you would have followed this goals-based rebalancing strategy, they would have earned an additional 1% per year over the last 10 years. I mean, it was crazy. And it's something I even do for my personal portfolio now. And it's been a really good tool for us. And it's helped my wife and I a ton in our personal finances.
I think that's like actually triggered me to think about the personal finance side, because I think it's easier for a corporate or for an organization to have a pretty determined goal, and everybody works towards that goal. But I personally find myself, working out on the hedonic treadmill, right? Like my goal keeps increasing when I reach closer to that point. And by that point, do I ask myself, like, is this enough? And should I increase my risk taking a little bit more? So I don't think I can be the person that set up the goal and execute at the same time. Maybe this is why we need a financial advisor for this.
Yeah. I mean, not moving those goalposts when things are going well is really tough to do. Because as you said, you get closer and closer to your goal, and you said, wait a minute, I hit my goal at age 45. I thought I was going to not hit it until I was 55. Well, let's go for more. But really, maybe that's a time when you should peel back. And what happened with my wife and I is in 2020, I looked at our financial model. I said, based off of what's happening right now, and this was probably March of 2020, I told my wife, we're going to have to work until we're 75. We've lost so much value in our portfolio. I go, we have to take more risk at this point in time. And we risked our portfolio in mid-March of 2020. And again, we caught that V-shaped recovery, and it wasn't a market call. I didn't do it because I thought the market was going to rally from the bottom. I think if you looked at my LinkedIn post, I was actually fearful that things were still going to go down. So it's one of those things where you kind of take the opinion out of it and just say, what do I need to do in order to reach my endpoint?
Yeah, that's great. That's great. And let's switch to like how you do diligence and how you kind of assess the people, the private opportunities, and when you are seeing like a lot of private funds, especially these days, private credits are super hot. When you are looking at the alternative managers, what do you look beyond their track record?
I might surprise you with this one. And you know how in real estate, people always say the three most important things are location, location, location. I'm going to say the three most important things when I'm reviewing a manager is going to be alignment, alignment, alignment. And here's what I mean by that is I told you earlier, I kind of focus on the investment thesis. All right. I want that good story. I want to know what part of the market you're trying to capture. I want to know why you think this is going to be an investment that's going to return positive results above and beyond a particular benchmark. And with that thesis, the other things I need to understand are going to be, how does your team fit that thesis? How are you set up in order to take advantage of it? How does your investment philosophy uniquely fit that particular thesis? How does your investment strategy fit that thesis? How does your risk management fit that thesis? And your company culture for that matter, I want all those things to drill towards and align towards that investment thesis. And you would be shocked how many times I have had a manager come in, pitch an investment idea that I think, okay, I like the idea. I like where you're going with it. Now tell me how everything is structured to take advantage of that particular idea. Why are you uniquely fit to have that investment thesis? In addition, this investment thesis, I hope, is something unique and something I haven't heard before and a little bit differentiated. Also, I need to be able to understand the thesis.
Yeah.
Simple enough that I can understand it. Because if I don't understand it, I'm not investing in it. Yeah, you got to thread this fine needle. It's got to be complicated enough that I can't replicate it or somebody else can't replicate it easily. But with those two things in mind, if it's unique and I can't replicate it, everything needs to be aligned. And I'll give you a couple examples. Is that I had a manager come in and they were talking about their quantitative process, their filtering process to narrow down the Russell 2000 into, a set of companies that they were determined to be viable to potentially invest in. And it was this big quantitative process. And I started asking them about the software that they used and how they, ran through their computer programming. The funny thing to me is that nothing was proprietary about it. They didn't have their own software. They really just took someone else's software product and kind of retrofitted it to their particular idea. Same thing with their risk management system. And I'm thinking something that you're relying so much on a quantitative basis that I would have hoped that in many ways you would have built your own. And that didn't happen. And on the flip side, I had a firm come to me and said that their true advantage was fundamental analysis. This was an international strategy. And I said, okay, how many portfolio companies do you have in your portfolio? And it was somewhere between 100 and 120. And when I talked about the team size, how many analysts do you have researching these opportunities? 3. And in my opinion, how can 3 people be managing 120 different companies, following 40 portfolio companies across industries, across geographies, and have deeper fundamental analysis than the rest of the street? Things like that, where your team structure and your philosophy just doesn't seem to line up with the thesis, that's where I start to have some issues or problems. And so when I'm looking at another manager, is I want that thesis to be strong, and I want all your processes, teams, and structure to line up with how you are trying to take advantage and earn returns above and beyond your benchmark.
Yeah, that's super insightful. Yeah, I think that the team should be organized towards the goal and the thesis, and maybe it's over time. A lot of alignments will happen, but I think people or managers should be more purposeful in making that alignment earlier, right?
Yeah, and I just realized how negative I was. I could even give you a good example if you find that would be helpful.
No, I think you are on the side of choosing, so I think you should actually watch out for those things. And on the topic of that, what are the red flags that do you see when some pitch sound too good to be true?
Yeah. So this is also something I find pretty interesting, is that 90% of the pitches that I see don't have anything negative in them. They never talk about the investments that went wrong, decisions that went wrong, or even when they have a particular thesis or strategy, they don't talk about the times when that thesis is not going to work. I want to know when this is not going to work. There's got to be a market environment where this is going to fail. And if they say that there's not a market environment that this is going to fail, that it's going to work across, all parts of the market cycle, that's a huge red flag initially. So the funny thing is, I talked, negatively earlier. I also want some of the managers many times to focus on the negative things. I would love when they shared, okay, here's a time when the markets just are not going to be in our favor. It could be even more recently, they could say something like, we're not going to participate when there's a narrow based rally based off the largest 7 companies in the S&P 500, because we're not going to be overweight, Apple, Nvidia, Google, Meta. And as a result, that we're going to fail in that situation. Okay, great. I at least now have that expectations and I know. So you're admitting that this is a time when I should be wary of your strategy. That makes me feel a little bit more comfortable. But in addition to that, I also want to know, when did you actually make a mistake? What happened? Why did that investment thesis not work out? What did you learn from it? And as a result, are you going to change your process to try and fix that? Or maybe there's a good reason that you won't, because you said, if I keep changing my process to fix this mistake that we made, it's going to negatively impact the other 7 things where that same process worked, right? But I want them to walk through that with me. I want to know the bad. I want to know the good, the bad, the ugly. And if you're not sharing the bad with me, to me, that's a little bit of a red flag.
Right. They should present enough information for you to assess independently with the good and bad, not masking it. Yeah.
Yep.
And so when you are looking at like AI, obviously is now over indexed to many people's portfolio. Is this something that you are actively working on, and any AI driven strategies or AI opportunities?
Yeah. And I'm going to go back to that last question for one other thing. My favorite managers are the ones who will actually send me a working Excel model, where if they send me their full model, they have that open transparency. That is a quick way to me to reduce any red flags or reduce any concerns. Very few managers will do that, but as someone who likes to dig into the weeds, I think it's fantastic what they do. Now, to your AI question, I know this is a
Yeah.
little bit out of order. Um, Here, my honest answer on AI is that I don't have the level of knowledge I need about AI. I have outsourced my AI decisions to the S&P 500 index. um, that's how I'm getting exposure to AI at the moment. Because honestly, if you put a bunch of experts in the room about artificial intelligence and where it's going to go and the domino effect and how it's going to impact various stocks, different sectors, and things like that, I'm going to be the person probably sitting in the room with my phone underneath the table, Googling what some of these acronyms and some of these terms mean. If that's the case, then I shouldn't be making any direct decisions about how to invest in AI. Now, do I think it's powerful? Yeah, absolutely. And I think that it could be a game changer within the economy. But as far as direct knowledge about what that impact is going to look like, I need to outsource those decisions elsewhere versus making those direct decisions myself.
Yeah, makes sense. And how does the like AI technology as a user benefit you? Like, are you using any AI tools that help you do analysis better, investing decisions quicker, anything that increase your productivity?
Yeah, so I'm a very, very light user of AI at the moment. I'm using it to help me build PowerPoint presentations, do general research on ChatGPT, help me clean up, emails and newsletters and things like that. And I think that I'm missing a whole bucket of opportunities here.
Okay. And what's your perspective on crypto? I'm curious to hear. It seems to start to go mainstream. It seems like we get a lot of recognition, and the price is getting through the roof. I kick myself for missing out on it. I had earlier investment and I sold it because I couldn't see the intrinsic value of it. As a financial professional yourself, what do you think?
The moment, I'm still struggling with what the intrinsic value in crypto is. And after your last three questions, I'm probably feeling a lot older than I really want to be right now. With my lack of AI skills and lack of knowledge about crypto. So ultimately, I always feel that every asset class, every thing that we invest in has to have some sort of purpose in the portfolio. And what I have not been able to figure out is crypto supposed to be my growth engine? Is it supposed to be a hedge to the US dollar? Is it supposed to be a hedge to inflation? Is it supposed to be an uncorrelated asset? Is it supposed to be my high volatility home run? Like, I don't know exactly where it fits and what type of characteristics it has. It seems like the trading of that and the price changes in crypto is, very random. So I have a hard time, investing in something like that. So I haven't touched it for any of my client portfolios. Candidly, I have put 0.2% of my overall personal portfolio in crypto because it's made me at least follow the price and try and figure out what's going on. But at the same time, if that goes down to zero, I really don't care that much and I haven't lost that much money. Um, but it's an interesting asset class. And I've listened to a few podcasts, and one of the interesting things that I've heard is that younger generations just don't believe in the stock market. They don't believe in the old ways that people have made money and invested because asset prices are so high and it's nearly impossible for them to get in at cheap prices. And they have started looking for other alternatives, whether it be things like crypto or private assets or meme stocks for that matter. I know that's a little bit of equity. And maybe that's part of what's driving it. And that could be a future that I just need to get caught up on. But I don't understand what the intrinsic value is of it. I haven't quite figured that out yet.
Yeah. Yeah. So, are there any kind of right now, um, in today's market, what market signals are you watching closely, and especially you think people are not looking at?
And this is something that I think people are watching and looking at, and it's in the news quite a bit. But
Uh,
I don't know, either I'm missing something or the market is drastically underestimating the negative impact that this could have. Is I'm looking at the US national debt levels and the consumer debt levels and thinking that at some point in time, this has to break. Now, a couple things that I've learned throughout my investing career is one, you never bet against the American consumer. And I have learned the hard way in some cases that is actually true. Because if you would have asked me about a year ago, I thought the American consumer was probably about to break, and they still haven't. But here's the other thing I've kind of learned about American culture is that we will push the limits and keep pushing the limits, even beyond the point where we know we're in trouble, but we'll keep pushing it until we break. And I think that's what's happening right now with our debt levels, that it's at an unsustainable pace. And if that pace that we have right now even slows down or contracts, it's going to cause that cliff effect and have a very negative impact on the market. And I just don't think equity valuations or interest rates would be where they are at right now if we thought that that was the case.
Got it. Yeah. So going forward, are you actively looking for any exposure, any increased exposure to your investments?
Well, a couple things. One is when I took over the portfolio, the foundation had not made any new private equity investments since 2018 or private investments at all since 2018. So we're a little bit behind on our private exposure. Now, guess what? That actually played out very well for the foundation because they were massively overweight or substantially overweight U.S. large cap equities because they had put new money in privates. So that is one thing that we are looking for. Now within privates, I have some interest in infrastructure, and what that space looks like. I do think it has a little bit more downside protection than maybe traditional equities or other private equity asset classes. I like that general income stream. Number two, within private equity and private assets, I'm kind of interested, and I know that private equity is really starting to go after this segment. It was probably an underappreciated segment about 10 years ago, is micro businesses. When I say micro businesses, think companies in the size of $1 million to $10 million of EBITDA. So, these businesses where the baby boomer generation wants to sell, but the next generation doesn't have the capital to buy them. And I think private equity is trying to step in and buy these assets. And they're, at least historically, they've been able to buy them at pretty attractive prices. Now, whether or not that's still the case is going to be interesting, but I do think that there's some opportunities there that we've been looking at as well. In addition to a couple other general themes and theses that I'm considering.
Yeah, sounds good. Okay, let's hit a few quick lightning questions.
Okay.
Whatever comes to your mind first. Okay.
Okay. Let's do it.
So, what's the first investment that you ever made?
It would be outside of my dad's help. The one on my own would be Dell Computer. Was my first investment. I love Dell Computers. I love technology, and it was still one of my favorite companies that I've ever evaluated.
Sounds good. And what's one investment myth that you wish would go away?
All right, I'm going to be dangerous with this one and say that the market is efficient. And I just have a hard time believing that something could be valued, take NVIDIA recently at, $2 trillion in one day, and then about a month and a half later, be at $4 trillion.
Great. Yeah, I agree. I personally agree. And what book would you recommend people to read, especially for capital allocators?
For an allocator and business book, I like the book The Outsiders, which is about 8 different CEOs and how they outperformed their industry. And I think that they each did something unique, but one thing that's going to wrap them all in common is going to be their how they allocated capital. And I think that's a really important component for CEOs, and I think that can make a difference, be a big differentiator in terms of overall performance of stock prices. It's called The Outsiders.
I see. Okay, I'll get one copy of that. And who's someone that you admire the most? A thinker, an investor, or someone that influenced you a lot?
Yeah, I wish I was working in my normal office because I would just point behind me. Because in my normal office that I'm working in, I've got this big painting of Abraham Lincoln. I'm a U.S. history guy, and I think Abraham Lincoln was a phenomenal leader, phenomenal strategy. I think he was very pragmatic in his decisions, and he did things that were a little bit unconventional. I mean, he basically on his cabinet were his opponents, people who thought differently from him, people that he ran against, because he wanted that, back and forth as far as different ideas and how to approach things. And he wanted those challenges built into his cabinet to ultimately come up with the best decisions. If he was alive today and people were able to channel him. I don't know if there's anyone better if I was going to bet on someone market timing, it probably would be him and his ability to really kind of figure out how the dominoes were going to fall in the future and what was doing things now that were going to benefit him, 5-10 years down the road.
Awesome.
Yeah. So
Interesting.
Lincoln is awesome. If you haven't read the book Team of Rivals, that's another book that you really need to read.
Awesome. I will. So thank you for sharing this incredible episode. And where can people find you, and what is the best way to reach you if they want to?
The best way to reach me will be on LinkedIn. Go out to Matt, look for Matt Zumbach on LinkedIn. Otherwise, Matt Zumbach at yahoo.com. I have probably aged myself way too many times in this podcast, and my email address at Yahoo is going to be another aging factor, because who still uses Yahoo versus Gmail? I do.
Gmail is no longer young anymore, so I guess it's the same thing. Yeah.
Just shows you I'm still decades behind. Matt Zumbach at yahoo.com or LinkedIn is probably going to be the best way to reach me.
Sounds good. Well, thank you so much for the incredible conversation. I really loved it. And there's so many good stuff that you wouldn't hear elsewhere. And thank you, Matt, for sharing this with us. And if you do enjoy the podcast, and please follow and share and comment on the show. And you can also find us on YouTube.
All right.
Thank you,
Austin.
everyone.
Really appreciated being here.
Thank you.